I'd like to welcome you to today's webinar, which is part of our ongoing webinar series on national fiduciary liability insurance for both our public sector and multi-employer clients. Today's presentation will serve as an introduction to our core national fiduciary liability insurance policies. Let me quickly introduce our speakers today, who comprise Segal's National Fiduciary Liability Practice. First, we have Segal Vice President Mark Dobro, Segal Vice President Matthew Jackson, and SVP and National Fiduciary Liability Insurance Practice Leader, Mr. Brian Smith, who I will now turn the mic over to.
All right, thank you very much, and welcome everyone. This is where we sort of take a step back and take a look at what we now consider to be our core products. Over the last year or so, we've actually expanded what we consider to be our core products. When the unit first started, it was the Fiduciary Liability and Fidelity Bonds. Kind of obvious why those two, Fidelity Bonds, are mandated, and fiduciary is something all trustees believe they need. But we've subsequently expanded it to include employment practices liability and cyber liability. And we're going to talk briefly on each of these. But most of this webinar, I'll tell you right now, is going to focus on the cyber because that's the newest and probably the one that's most unknown. But let's spend a couple of minutes and do the basics on the first three of these core products. The Fidelity Bond to start with. We start with this one because it's mandated by ERISA. It's the only insurance policy that ERISA actually puts a mandate on. Everything else is optional. This one's not. Any plans where there are assets and there are people who are handling plan assets, they must be bonded. And when we're talking Fidelity Bonds, what's important to remember is it's a generic name. There are many different types of Fidelity Bonds. They cover different types of risk. ERISA, however, has very specific mandates and regulatory requirements as to what this particular Fidelity Bond must do. If you haven't seen the DOL Field Assistance Bulletin of 2008-04 and you're an attorney, pick it up and make sure you read it. It really does provide clarification, and it's the first clarification that the DOL has ever issued on this subject that I'm aware of. It's almost like our Bible. We refer to it continuously. The types of bonds, they can be very narrow in their scope. They can be very broad in their scope. And both are absolutely legitimate and both are absolutely permissible. And I'm using that absolute word that I don't usually like to use because ERISA, the DOL in its Field Assistance Bulletin says that trustees have the flexibility to decide how they want to be compliant. And these different bonds give them different options. And the biggest differences that we see is not only in the coverage, but also in the price. And it's because of the price that we always want to present both of them, at least until the discussion has been held and the trustees have made up their mind of what they want to do. So that's a quick review of the Fidelity Bond. Fiduciary liability. It's a type of malpractice. It's an errors and omissions type of coverage. It protects you if someone alleges that you made a mistake or you mishandled something or you didn't do something correctly. It's not mandated, but we think most trustees always want to have this coverage, and it's perceived almost like a mandatory coverage. Again, like the Fidelity Bond, there are many differences in the policies, and as the marketplace has evolved over the years, we see those differences as being more and more important, and one of the really big distinctions we see anytime we do a free policy review. So anytime you're looking at these fiduciary policies, the scope of coverages becomes our paramount concern unless we are instructed otherwise. And we are always looking at what the market looks like, what the premiums are doing, what coverage restrictions might be introduced during a hard market or a transitional market such as we're in now, right now. And that's our role on your behalf as brokers.